Welcome to the Money and Meaning Show with Jeff Bernier, a show dedicated to helping you gain the confidence and freedom to lead a life of personal significance and help you get your actions and resources in alignment with what matters most.
Well, hello and welcome to the Money and Meaning Show. I'm Jeff Bernier, so glad that you decided to join me today. This is a show where we explore the intersection of wealth, purpose, and decision-making in a complex world. And today's conversation is one that I'm going to rely on some information from a recent podcast that I watch that challenged one of the most widely accepted ideas in investing. And that idea is that stocks are safe if you hold them long enough. You've heard it. You may even believe it. Heck, I believe it. Globally diversified stocks, if held for the long run, are safe if we define safety as the preservation of purchasing power over a long period of time. But what if the real risk isn't the market? What if the real risk is you? Precisely your life circumstances. And that's what I want to talk about in this perspectives version of the show. So today I'm going to unpack a little bit of research that was presented recently on the Rational Reminder podcast. Some guys that I met years ago that have a great show called the Rational Reminder Show. Very technical podcast about investment management largely. I'm going to unpack some ideas in a recent show which basically tried to illustrate that market crashes don't hurt investors who can hold on. They hurt the ones who can't. And that's pretty obvious. But that distinction changes everything. So while stocks might be safe in the long run, a la Jeremy Siegel's classic book, Stocks for the Long Run, and as I mentioned before, in terms of the preservation of purchasing power over long periods of time, but that assumes you hold. And unfortunately, many people don't hold. So let's start with the traditional story for a minute. And again, all of this came from some research that Patrick Adams, a PhD candidate who's done a pretty extensive research on some of this, presented on the Rational Reminder Show. But let's get back to the basics as a level setting here. And that is, U.S. stocks have been incredibly resilient. There hasn't been a single 20-year period with negative real returns. And so that's the foundation for the whole idea of the stocks for the long run philosophy. But there's a hidden assumption here. And the hidden assumption is you have to stay invested for the entire time. And that's where theory collides with reality. Because in real life, people don't just ride out downturns calmly. And it's not all because of behavioral reasons. They often face job losses, income shocks, unexpected expenses, and lifestyle commitments that don't pause when markets fall. And when those pressures hit at the same time as a market crash, they don't just feel risk, they're forced to act on it, as highlighted in the episode notes. One of the comments Patrick Adams said was many investors sell during downtimes not out of panic, but because they have to, which is what I was just illustrating. So that's a very different type of risk that we want to talk about. So why people sell at the worst time. So let's go deeper with this for a couple of minutes here. So what he did is he took research using U.S. tax data that showed something quite striking. High-income households, some of those that are often thought to be the most sophisticated investors, consistently sell stocks during market crashes. Now, he was looking at taxable accounts only, so this understanding on the parameters here, but they sell not because they don't understand markets or because of their panicking out for behavioral reasons, but because their financial lives are more fragile than they appear. And here's why. First of all, income risk is real. Many high earners, especially in finance, technology, or business ownership, have incomes that move with the market. So oftentimes, when we have a market downturn, their bonuses also disappear, or their revenue falls, or jobs become very uncertain. In fact, a meaningful percentage see incomes drop by 50% or more during a crisis. And that makes sense if a lot of your income is based on stock options or bonuses or things like that. Income risk is real, even to relatively sophisticated or high-income investors. Number two, liquidity is tighter than it looks. Even wealthy households often have illiquid assets, large homes, retirement accounts, businesses, and limited liquid savings. For many, liquid assets only cover months. This might be the most important insight of all for all of us, not just the high-income earners. A large portion of spending is non-negotiable. Think about these households. You might have a mortgage payment, tuition payments, childcare, insurance, health care. Those aren't nice to haves, they're commitments. And so the research calls these types of commitments hidden leverage, because without even having any debt, the lifestyle creates fixed obligations that must be met. So the result for many of these and for many investors is when markets fall and income drops and expenses stay fixed, investors don't rebalance, which is what the theory says we do, they liquidate. So this leads to a powerful reframing of risk, not just being volatility. Risk is the probability of being forced to sell at the wrong times. And once you see it that way, everything changes. Asset allocation stops from being just a math problem and becomes a life design problem. So the traditional model would say young investors who are in their peak earning years can have high equity exposure, and retirees need to have lower equity exposure because they need lower volatility. But what some of the research that Patrick Adams did showed sort of a counterintuitive switch to that. As a matter of fact, some retirees can actually afford more equity risk than these working professionals, at least in their non-retirement accounts, in their taxable accounts. Why? Because often retirees don't have labor income tied to the market. If you're in retirement, you're not subject to your income going away if the market goes down because you don't have earned income anyway. Often retirees have more liquid, diversified assets and have certainly, normally, fewer fixed obligations. Meanwhile, these wealth builders, these high-income working professionals, have more market-correlated income, have higher fixed expenses, and might have limited liquidity. So their true risk might be higher than it normally appears. So what does this mean for the portfolios? How do we translate this information into real decisions? And so I've got 4 sort of practical takeaways for all of us. Number 1, your portfolio is only as strong as your liquidity. An emergency fund, or what we call a short-term portfolio, isn't a side note. It's a core part of your strategy because liquidity buys you one priceless thing, the ability not to sell. Or as Charlie Munger used to say, never interrupt the compounding. Well, if you have to liquidate because you got to pay your kids' tuitions or you got to pay your mortgage payment or you've got to pay other expenses, even though markets are down, you don't have that luxury. So your short-term portfolio or your emergency reserves, they're really critical here. So it gives you the ability not to sell so that you can benefit from the, quote, stocks for the long run. Number 2, equity exposure should reflect your life, not just your age. So these rules of thumb about, you're this age, so you can expect have this level of equity exposure, and you're a younger age, so you could have much higher equity exposure. That's not near as relevant as your life circumstances. So it's not really about how old are you. It's about how stable is your income, how flexible is your spending, and how much liquidity do you have. Number 3, fixed expenses are financial gravity. And this might be the most important insight of all. The more rigid your lifestyle, the more conservative your portfolio likely needs to be. A large mortgage, private school tuitions, high fixed costs. Again, these aren't just lifestyle choices, they're risk multipliers. Number 4, diversification isn't just financial, it's behavioral. So we often think of diversification as stocks and bonds and alternative investments and other categories, but real diversification includes your income sources, your expense flexibility, how can you dial up or dial down your expenses, and your liquidity buffers. Because the ultimate goal isn't maximizing returns, it's staying in the game. Again, back to the Munger quote, never interrupt the compounding. Number 5, the deeper meaning here. And this is where money and meaning actually comes in. Because under all of this is a deeper question. And that deeper question is, what does it mean to be financially resilient? It's not just about net worth. It's about optionality, flexibility, and the ability to adapt without breaking. A life overbuilt on commitments is a life that becomes fragile under pressure. But a life with margin is a life that can endure uncertainty. So here's the takeaway in closing. Markets don't just test your portfolio. Again, we might be very resilient emotionally, but they test your life structure. Ultimately, the best investment strategy is the one you can stick with when it matters most. Thanks for being with me today. I hope you found some of this research interesting. If you found this helpful, it resonated with you, please share it with a friend. Give me feedback. Would love to hear from you. You can reach me at moneyandmeaning@tandemgrowth.com. And of course, you can check out all past episodes wherever you stream your podcast. And of course, you can check us out on our professional website, tandemgrowth.com. Thanks again. Great seeing you all. Talk to you next time.
Thank you for listening to the Money and Meaning Show with Jeff Bernier, a show dedicated to help you gain the confidence and freedom to lead a life of personal significance and help you get your actions and resources in alignment with what matters most. We would love to hear from you. If you have any questions or comments on the show, feel free to reach out to us at moneyandmeaning@tandemgrowth.com, or you can find us on the web at www.tandemgrowth.com. Jeff Bernier is the President and Chief Investment Officer at Tandem Growth Financial Advisors, LLC, an SEC-registered investment advisor. This show is a production of Tandem Growth Financial Advisors, LLC. All information discussed is general in nature, is provided for informational purposes only, and should not be construed as specific financial, legal, or tax advice. Listeners should consult an attorney or tax professional regarding their specific legal or tax situation. Listeners should not rely on the content of this podcast as the basis for any investment decisions. A professional advisor should be consulted and/or independent due diligence should be conducted before implementing anything discussed in this show. While information presented is believed to be factual and up-to-date, Tandem Growth Financial Advisors, LLC, does not guarantee its accuracy, and it should not be regarded as a complete analysis of the subjects discussed. Tandem Growth Financial Advisors, LLC, does not make any representations or warranties as to the accuracy, timeliness, suitability, completeness, or relevance of any information prepared by any unaffiliated third party, such as guests on the podcast, and takes no responsibility for the same.